Welcome to the weekly update, where I'll go over the action in the market for the week of April 8th through the 12th, and then we'll see how things are looking for the week of April 15th through the 19th. Before I get started, I am dealing with a bit of a flu bug as I record all the videos over the weekend. So if you hear me stumble my words or mess up my train of thought a little bit more than usual, please, I ask your forgiveness and understanding in advance for that. We ended up having another down week, and there are some things to be concerned about. There are some long-term signals that we want to keep an eye on, but at the same time, on the daily charts and even longer term, we're still at some support, some pretty significant support that may define whether this is a pullback and we're going to be able to bounce up out of that, or if we fall through this and things look to deteriorate even more than they already have, that this could lead to an actual correction. We don't know that at this point. We can just evaluate things day by day, and in this video, week by week, to see where we stand. Before I get started, please know that I do post videos every day, and this is the real foundation of my analysis. I use the weekly videos, the intermarket analysis video, the deep dive video, the what to watch video. Those are just around the outside, where the daily video is the real hub of my analysis. I found over the years an intraday analysis that's not, there's too much noise intraday. A weekly chart, it's helpful, and we want to get an idea of what's happening longer term, but that tends to be too long sometimes for the types of strategies that I implement. So I found that daily analysis seems to be quite well. So if you are watching this and you don't know that I post daily videos, please feel free to check those out. I provide commentary and analysis. And my videos are a little bit longer. They're 30, lately they've been over 30 minutes long each day. I know people are busy. I know some folks are looking for quick answers. We have to respect the idea of doing analysis and looking at different areas. You can't just do it with one or two little indicators. It takes looking at the market as a whole to see what's going on so we can get a real feel for what's happening. Now, that's where I come out. You may have a different opinion about that. I'm also in the process of posting some videos about the program that I have that I hope to launch in June. I tried to record a video this past week, and then just about the time I finished up, there was some construction noise that kind of ruined that whole take. And so I'm still in the process of putting those out. There is a PDF that's available in the description below every video that I post. Some folks find that helpful. Then the very last video that I do that is supposed to be on an as-needed basis, but is developed into a weekly video, is a what to watch video. And these are the areas that I'm really keeping an eye on, really honing in on. Because I look at many different indicators, I look across multiple markets, there are certain things that emerge and change over a period of time to say, okay, this is what I'm really focused on right now. And then that may drop off, and we may not look at that for a really long time, maybe years even, and then it might come back into play. Just as an example, a chart that I'll show you later on is a weekly chart of the S&P with pivot points. I ignored those charts other than focusing on them a couple of times over the last few years. Over the last 2 or 3 months, I've been really honing in on that chart. And so to try to say what's important and what's not important, it's pretty much dictated by the market itself. And then I reach a consensus with all of my analysis to put things together. That's my approach. Again, you may have something that differs from that. There's a thing that I post on the community tab every day called pivot points, and these are built-in support and resistance levels that can be quite helpful. They are the same for the whole month on the daily chart. I just update that with the new bar for that particular day. There's intraday pivot points, and those do change every day, and they're based on the previous day's action. And these are very helpful if you're trying to get an eye on what's happening more inside the market. Also, I do have a private Facebook group, not really active. I'm the only one that posts, and I only post when I've uploaded a video. So I may be changing or morphing that into something different as the program actually gets going. I already posted a new poll for the upcoming week, and I will be going through the results of the latest poll. And then I'm still playing whack-a-mole, it seems like, especially on Rumble, with these folks that attended some kind of webinar or something and or have been promised millions of dollars by becoming a YouTube or Rumble expert and being a consultant for folks. And I just delete those. Now, if you have a serious comment, whether you agree or disagree, or you want to point something out that maybe I missed, those are great. I love those comments, and those are always accepted. But if they're crap comments, they're spam comments, they get deleted right away. Also, another thing that I found easier is, and here's also know that I do post on Rumble, and here's the link. There's another thing I want to bring up, is that when some of you ask questions, especially if you're new to the videos and you don't really know about my approach, and you're like, man, you sure look at a lot of stuff. How do you know what's important, what's not important? And I get that, and I cover that in my course. But if you have a type of a comment that requires a little bit longer response from me, first of all, it would be easier to send me an email if you're okay with doing that. And then a lot of times what I've been doing is I'll actually respond not with an email, I'll respond with a video. And I'm a good writer, but I'm a slow writer. And so I can put together a video quite often a lot quicker, and then I can stumble and bumble my way through that. And then try to have the video, it's just for you. It's a private link that nobody else can access. That's why I have to have your email address, so only you have that link, because you wouldn't see it on the YouTube channel. So let me know if if you have something that you want me to go more in depth. Just know that sometimes that's a way that I do respond. Okay, let's go back and talk about the week's session. We were down 1.56%. So we've had a couple of down weeks now, and we were still below average with volume. We were right at average with volume in Friday's session, but for the most part, pretty much ever since before Easter, we've been below average with volume. We're still looking okay in the bigger picture, but we're looking vulnerable as well. We were seeing a really solid uptrend. Now we're trying to decide, okay, it's looking more than just a pullback that we're seeing. We're actually seeing something a little bit more than that. And if this develops into something even more severe, it actually, as I said, could turn into a decline. And it's about inflation and interest rates. We're getting stronger than expected economic reports, especially when it comes to CPI. And that's what really forced things down on Wednesday. Then we had PPI come out, which was weaker than expected. The market liked that, and we really shot up. Earnings reports came out this past week on Friday for the banks. They were not well received. And that is one of the things that really produced the downward move that we saw in Friday's session. And because of this gyration, where not everything is Goldilocks necessarily, the market's getting a little more apprehensive. And we also have some geopolitical concerns. There's some situation going on between Iran and Israel right now. And for the most part, the market doesn't really pay attention to these things unless they really escalate. And even then, they tend to become part more of pop news. They last one or two cycles and then kind of go away. Like when we saw last October with the beginning of things in Israel, the market reacted to that, but it really didn't last. But we still want to be aware of these things nonetheless. And then any Fed speak that we may get. As far as our trend right now, we're still positive, but we're starting to show some weakness on the weekly chart. The green line's on top. The ADX is coming down after giving us a pretty extreme positive reading above 40. And so we are seeing a little bit of a pullback there. All right, here's just some bullet points to go over. They're not major things, just generalizations that I made of what happened this past week. We did have solid losses. This was more of a significant down week than what we've seen. Interest rates ended up closing at 4.5% for the 10-year yield. Those are going up. That's also pressuring the market. And the dollar has been going up as well. And it's going up pretty strong right now. And there's been this recalibration of these rate cut expectations. The ideal is that the Fed is probably done raising rates. Now, that can always change if we get some really solid economic reports. But at the same time, the Fed has pretty much said that. Now it's, are they going to cut rates? And that is the part that the market is trying to figure out and rework. And then there's also these geopolitical tensions that I mentioned. And then CPI was stronger than expected, whereas PPI ended up being cooler than expected. And bank earnings were not taken well in Friday's session. This is a chart that I've been showing for almost a year. The reason I keep showing this is because it is a very long-term chart, and it shows you what inflation was from 1966 to 1982. That's the blue line. And it appears that we're still going down as far as inflation is concerned. There were even some blips back up, and we might see that throughout this whole process that we're going through if we stick to this general idea that what has happened before is happening similar again. But the concerning part is, look what happened after that. When we get into the mid to late 70s, this is when we saw hyperinflation, actually stagflation. We had massive inflation with really no economic growth during that time. This was a really difficult economic period if you were around at that time. And then we finally started coming back down in the 80s. We're getting closer now, a little bit further down here. And that's why I don't update this chart, because it is very, very long term. And this is according to some RenMac research that I found on Twitter months ago now, where they went in and they said, okay, when the 10-year yield is above 4.02%, that's when it can really start to affect earnings for companies. Well, right now we're at 5.5%, or excuse me, 4.5%. Here's the poll results. So the first question is, earnings season will start in the upcoming week, which really, I mean, it never really ends and it never really starts. It just kind of slows down and then picks up. And now we're starting to come into the stronger part of earnings season. Do you feel that earnings reports will be positive or negative in general for stock prices as the earnings season unfolds? Split 50-50. Well, didn't get off to a really good start with the banks reporting. Then the broad market has held up better than the mega caps recently. Now we're kind of seeing a shift back right now where the mega caps are doing a little bit better. But as of a week ago, the broad market was doing better. And do you feel that the mega caps will show renewed strength or continue to languish? 86% thought that mega caps will languish. Well, we're kind of, and it's not that the mega caps are doing great. It's just that they seem to be holding up a bit better for right now. Do you feel that interest rates will keep going up or will start to decline in the upcoming week? Up 57%, and they did go up on the week. And then as of last Friday's close, many indexes are at a tipping point. And that's kind of what I was calling the videos a week ago. We were at that point where we could justify breaking higher or justify breaking lower. Turns out we went lower, at least to this point. Do you feel that this will lead to stocks going higher or lower or sideways in the upcoming week? 40% thought higher, 60% lower. Nobody was indifferent on that one. And I'm trying to add more of a neutral type of thing in some of the questions that I ask. Here's some Isabel Net blog charts, and I've been watching this for a long time and explaining it here, where if the Fed is able to deal with interest rates because of what's going on in the U.S. economy, maybe it's slowing down a little bit, and so they cut rates. That is more positive for stocks, where if we get hit with some kind of black swan event, something really like a catastrophe or something, that's when the Fed will have to cut rates for a different reason. And that usually takes the whole economy with it. And that tends to be more negative for stocks. We are still seeing a consensus going up as far as earnings. This is updated once a week here. And that justifies stock prices going up and the prices that we're at right now, because you're buying future earnings. And if future earnings are looking more positive, that justifies stock prices going up. And this is the Citi Economic Surprise Index, where we were coming down here on the US. This is the global and then the US. And this was more friendly to the market. It just seemed like, okay, the economic reports are weaker than expected. And this was giving some idea that maybe the Fed can come in and cut rates. And they've even kind of said that and showed that by the report that they released. Well, now this is starting to go back up, and this is putting some pressure on the market. So when I say, and that's why I go through the economic reports every day and I say whether it was stronger than expected, weaker than expected, we look for a consensus. And right now that consensus is showing more economic strength, which is spooking the market. And FactSet had a couple of posts. They'll get a little more busy now because we're coming into earnings season here, where it says S&P financials, because they reported on Friday, but this post was from last Monday. Banks expected to report largest decline. We're over here. They're just not looking all that strong. And then this is another chart showing how things are looking going forward. They're reporting now for the fourth quarter of 2024. So they didn't really have all that good of a quarter. And then S&P is likely to report year-over-year earnings growth of at least 7%. And here is the forecast over here. We won't know that until it's actually done. And then looking at 5 years, this is also the forecast, and it's showing some improvement. And that is holding up for right now for stock prices. And then here's our intraday chart. We go back to Monday, where it wasn't all that big of a day. We did see a real decline on Tuesday, but then we came down to this S3 level and we were able to bounce up off of that and then actually close near the high for the day. Wednesday, this is when CPI came out, and much of the loss was actually seen in the gap lower open. And we didn't really move all that much throughout the session. We just stayed negative. Then PPI came out, and we're actually looking to repair much of the losses, and we actually closed near the high for that day, just a little bit above what was S2 on that day. Then the banks came out. Things are looking a little more tense geopolitically. We ended up gapping lower, but then there was more of a follow through here. And what's really interesting, this S2 level, this is 5110. And I've been for months now looking at the 5110 to 5111 level as major support, and it actually lined up as an intraday support level in Friday's session. We tested it twice on Friday, and we were able to bounce up off of that. Are we going to keep going, or are we eventually going to fall down below it? The market sees what we're seeing right now, and so there could be some real decision making if this point is challenged again. So for the week, and this is just the 5 trading days that we went through, we were down across the board, with the small caps and mid caps being down the most. And then going back to the beginning of the year, we do have small caps and mid caps, and a lot of things have now switched negative. Going back to the beginning of 2023, this is actually, okay, this is a weekly chart of the indexes here instead of year to date. Forgive me for that. I didn't download the correct chart. Looking at sectors, we were down, so I sorted according to what was down the most. We have materials, communication, energy, and tech. They were down. Actually, I need to go over here. And then over on the right-hand side, this is according to a scooter score. The stronger that particular sector, the stronger the higher the score will be. We only have energy, which is in the 90s right now. We have some that were strong, but they are falling back. And we have healthcare, which is the weakest currently. This is in a relative rotation graph, where if you go back to your geometry class, where you have an x-axis and a y-axis, when we're to the right of the y-axis on the x-axis, that's a plus. So this upper right-hand corner is plus plus. These are the areas that are the strongest, and it goes back 1 year. Industrials are doing the best, where we're seeing financials, communication, and tech showing some weakness right now. And then way over here, we're seeing real estate, which is not doing very well. This is the minus area here, just to kind of give us a little bit of a visual view. And then you can see how it's changed and how long that change has been taking place by the tail. This is looking at the different indexes, and I compare it to the Wilshire 5000 going back over the last year. We have the OEX, which is the S&P 100, and the S&P 500 still holding up fairly well. We have the NASDAQ 100 showing some weakness, and way over here, utilities are the area that's really been struggling a lot. Then let's see if I did this part right. These are the sectors just for the 5 trading days, where we had tech, staple, and energy were up. Communication was up slightly. And then going back to, this one is right. Going back to the beginning of the year, we have energy, communication, tech, and industrials. They're positive. All the other sectors are negative year to date. Looking at our fear and greed index, we really fell here. We're down into the neutral area. We came in at 46. So we have been right around this 70 to 75 level, showing good momentum. But as I always point out, when we get to these levels, maybe we're getting a little too optimistic about things. When we get very high readings, that's when we start to look at using this as a contrarian indicator. We can ride it when it's going up, or we can ride it when it's going down, but we were up here for quite a while, and now we're starting to trail off just a little bit. Here's the active asset managers. They had become extremely positive, and now they're starting to pull back in their view on things. Here's another look at that same chart where they're showing a bit of a decline after being extreme positive. Here's the VIX where we saw it really going up, both with the line chart and the bar chart. We had been getting some much lower readings, and we at one point actually broke this series of higher lows. Well, now we're starting to go back up again with the VIX as fear is increasing in the market. The Ulcer Index, we're actually coming up to the moving average on the daily chart. We're just kind of blipping up here on the weekly chart. This is the RIDEX bear bull ratio. When this goes up, that means that folks that invest in RIDEX mutual funds, they're into the bearish funds, which make money when the market goes down. And when this ratio is very low, which is and this is as of Thursday's close, they became really bullish again. So they're in the S&P 500 fund that benefits when it goes up. It's probably going to change because there's a 1-day lag on this ratio. And we did come down a little bit with our investors intelligence survey, but it's still giving us a very high reading. This only comes out once a week. It's probably going to drop with the decline that we've seen. And the American Association of Individual Investors, they're still looking rather positive, but not extreme positive right now. But the 50-period moving average continues to go up slightly. Now, this is still positive, even though it's going down. I know it's kind of counterintuitive. This is the tech sector, and that's the black line. And we compare it with 1 to 3 month T-bills, or you could pretty much call that cash. When this is going down, that means the tech sector is outperforming cash. We ran into some problems in 2022 when it would have been better to just hold on to cash than to be in the tech sector. Well, now this black line's going back down. We have seen some recent weakness, so we're seeing this turning back up, but it isn't changing its character right now anyway. Economic reports, looking at GDP, the latest readings here, according to the Atlanta Fed GDP Now estimate, well, we're coming in at about 2.5% to the upside with the forecast, and about maybe 1.25% to the downside, and we're at about 2.25%, 2.33% or so with their latest estimate. Here's another look at that same reading, just to give you more what might be a little easier to see. The takeaway from this is not only have we been positive with GDP, but the forecasts are that we will continue to be positive, because a definition of a recession is when we have 2 negative quarters of GDP. Looking at the spread between risky and not as risky bonds, even with the downward move we've been seeing, this ratio still continues to go down. So this is not changing yet either. And then the latest reading from the Chicago National Financial Conditions, we get nervous when we go above the black line. We're still well below that black line now. And this hasn't been updated since the beginning of February. This is a quarterly report. I may even drop this chart at some point. It's really not all that useful. This just shows how the tightening standards at banks have been dropping off. And then we did have this updated a week ago, the real-time SOM rural recession indicator. We're above the black line, but we're still below the red line. We get nervous when we go above the red line. The same thing is true here with the smooth U.S. recession probabilities. We're going up a little bit, but we're still far away from the red line. The Brave Butters leading index was updated on April 1st. It's coming down just a little bit. So that's not really causing any concern at this point. Looking at inflation, we did start a new quarter at the beginning of April. So these are just the latest readings. And this changes every day with what they think inflation will be as far as CPI and core PCE. Keeping an eye on the Fed. They're going to be meeting on May 1st, and there's a 94.1% chance that they will leave rates unchanged. And that really hasn't changed all that much. The blue line here, that's where we're at right now. Day ago, week ago, a month ago. There was some speculation earlier in the year that the first rate cut would be in May. Doesn't look like that's going to happen now. Then we look at the next out meeting, which will be on June 12th. And there's a 71.7% chance that they'll also leave rates unchanged at that meeting. And this has changed over time too, where folks were a little bit more confident that they were going to cut rates. Okay, let me get a good handle on this. But now it was looking more like a rate cut, but it's becoming more firm that they'll probably leave rates the same at that meeting as well. But this changes every day, so we just have to keep up with this. This is the Fed balance sheet, where we are seeing a little bit of additions here to the balance sheet. There were some rumors that it's not official. It hasn't been announced or anything, but there's just some ideas that the Fed may be coming in and actually starting to buy some things as a form of quantitative easing to help prop things up a little bit. But their official stance right now is that they're in quantitative tapering, but they have said that they're going to start not doing that as much. They started in June of 2022, and that's why we see the balance sheet going down. This is the year-over-year change where we're still seeing things falling off of the balance sheet here. Looking at breadth, we're still looking okay here when we look at price and volume, although we did turn down over the past week. And when we look at our new highs, new lows, we're coming down with our 4-week average. We're also declining with the 10-week average, and we're really dropping off with the new highs. There's a few more new lows here, but we're not really seeing a big expansion, at least yet. The advanced decline ratio is declining, but still above 0. So that's hanging in there positive. The accumulation distribution, and this tries to measure smart money because it takes volume into its calculation. It is coming down longer term, but it's still above this upward sloping trend line, or this moving average here. On the daily chart, we're right on the moving average still. Looking at our trend, and I use this to determine what kind of strategies I implement. I implement different strategies, whether we're in a trending environment or in a non-trending environment, where most folks tend to be always trending, either up or down, with most people usually being up. They just go long in investments. That's why I use this. And I really like this indicator because it gives us so many things. The black line is the ADX. This is average directional movement. And then I plot a moving average on here. When we're above the moving average, that just gives us some context to show us that the trend is strengthening. We're rolling over a little bit, but sometimes when one of these lines here gets to 40 or above, that usually is an extreme reading. And we're starting to roll over here with the ADX itself. Now, we can also take away whether we're going up or down or whether we're positive or negative. The green line is on top, so that means we're positive. Now, we've switched over to negative on the daily charts. Even though we're declining with the green line, it's still above the red line, which is coming up, but well below the green line for right now. This is the Erin indicator, another kind of crazy indicator that tries to measure buyers versus sellers. The green line are buyers, and that's coming down just a little bit, but the sellers are also declining. That's the red line. And then the difference between the two is the oscillator that we see at the bottom. We're above 0 and we're flattening out for right now, but we're still positive with this indicator. The mass index is not generating a signal. This is a daily chart where we've come down to the 50-day moving average. So that's a pretty significant support level. And this is one of these buy the dips types of things that a lot of people implement. We fell below the 20-period moving averages on the daily chart. Now we're down to the 50. We'll have to see. Are we going to get a bounce up off of this 50-day moving average? If we end up closing down below this, that's going to turn things quite a bit more negative. And then this is the Keller market model. After Friday's session, we're short-term negative across the board when we look at the S&P, mid-caps, small caps, and NASDAQ 100. Looking at a broader market measure here, we're negative in the short term with stocks, we're negative with bonds based on price, and we're still negative with commodities in the long term. The decision point trend signal did change to a downtrend after Friday's session where it had been positive. Our trend channel, we're pulling back a little bit, but we're still well above the midpoint here. And this trend channel goes back to 2009. This is the chart that I've really been focusing on. I almost ignored this chart except for the weekly videos until I saw what was happening back in late 2021. Then I didn't watch it for a long time because we hit this pivot point and then we went into 2022. We came back up and hit this pivot point in the summer, late July, early August 2023, and then fell back. Well, now we broke above this and things are looking okay, but we're coming right back down to this level. This was S2 for the intraday chart. This is R1 right now for the weekly pivot point. You see how they're converging all with each other? We're also dealing with some 50-period moving averages. We also have other indexes that are at support as well. We're seeing this all coming together. So if there's going to be some kind of a bounce out of this, the market's going to have to come through pretty quick right now. If we see all of those different areas fail, then things could really turn much more negative. But when we look at the trend, even though we're pulling back with the S&P, we're still above the 50 simple moving average. This is 50 weeks. And both of these lines are, well, the red line's going up, even though the black line's pulling back, and the black line is above the red line. When we look at our crossover trend measurement, we're pulling back, but we're still positive here. And we're getting extreme negative with the McClellan oscillator. We're also extreme negative on the daily chart as well. We may see some bounce out of that. We don't get any, well, we do get some extreme negative readings, but the fact that this is giving us such a reading, there may be some more weakness yet still to come, but we might see some recovery here as well. This is the summation index. This is longer term, and it gets its figures from the McClellan oscillator. We're coming down after being extreme based on price, but we're still above zero. We're also coming down based on volume, but we're also still above zero. We're below zero when we look at the Swenlin trading oscillator based on price and volume. We ticked up this past week. It would be more positive if we could get back above zero. And this is another, I like this indicator very much, is the bullish percent index. It's not moving average based, where most oscillators and of course moving averages are moving average based. This measures the point and figure buy or sell signals inside of a particular index. In this case, it's the S&P 500. We get a little nervous when we go above 70. That's an extreme reading. And then we really become nervous when we drop below 70. That's actually a sell signal. And we're continuing to decline here. And we're seeing pretty much that same thing on the daily chart. We could still turn and go back up from here. But if we continue to fall and go down to 50, that's going to turn things a lot more negative. Then we look at the momentum. We're rolling over just a little bit with our PMO. This is the price momentum oscillator. We're declining based on price as well as volume, but we're still above zero. And then we have some PMO studies. This was an indicator developed by Carl Swenlin, and out of that came all these studies that I like to use. We're looking extreme negative now with the PMOs that are rising, seeing that same thing on the daily chart. The buy signals are also extreme negative, seeing that on the daily chart, and we're declining here with the PMOs that are above zero. We're seeing that on the daily chart, but it's not going down as much. The angle of attack, I guess you would say, is not as great on the daily chart as it is here on the weekly chart. The Bollinger Bands, and you can use these a bunch of different ways. We look at when we're above the midpoint, which we are, even though we're falling back. If the lines themselves are going up, you can see the distance between the lines. We can also look for divergences, either positive or negative divergences here. What I measure here is the percent B, and this just measures when we close up above or down below the Bollinger Band. That tends to not happen very often, and when it does, it tends not to stay that way for very long. Right now, we are coming down with the declines that we've seen, but we're still above the midpoint. Then looking at the momentum, we're actually looking more negative on the slope, and this is our short-term oscillator. It's the touchiest, but this has just been giving us a really extreme reading, and it's coming down. Starting to roll over with our other short-term oscillator, the TSI, rolling over a bit, but still positive with the MACD, the PMO, and the PPO. And then we have long-term oscillators, the TRIX and KST. They're still continuing to go up. Chaikin money flow, starting to show some weakness. We're still negative on the daily chart, but kind of chopping more or less sideways lately. But this is also showing some more weakness after giving us a really, really high reading here. The Chaikin oscillator is actually positive on the daily chart, but we're continuing to decline here on the weekly chart after being extreme positive. The force index is still positive, but is declining. The money flow is continuing to decline after giving us an extreme positive reading. The rate of change, since we had the down week, we're below the midpoint with the decline. Going back 50 weeks, we're coming back down. We were getting a little nervous with our 50-week rate of change because we were getting above this red line. Now, there's nothing magical about this red line. I draw this red line on here. I use this as more of a reference point. And sometimes when we get above this point, that causes some concern. Well, now we're starting to fall back. This is also another concern, not because RSI is the greatest indicator in the world. It's really not, but it's one of the first ones that people learn. And millions of people watch this indicator. And on a weekly chart, it is now, after being extreme positive, has now generated a sell signal. This could be negative. Now, it could turn and go back up and show some nice little action here. And I know a lot of folks use the daily version and so forth. But this is more one of those things where I watch this because so many people do. And they're going to be seeing this, making longer term decisions, and that might be negative for the market. We also have a special K chart. We're still negative here, where the daily chart continues to be positive. We still have not been able to cross above this moving average in 2024. Stoch RSI, this is one of our touchier indicators. It tries to take stochastics and RSI and put them together. We're looking extreme negative right now. And the Williams percent Rs, after being extreme positive, is now starting to drop down, another possible warning sign. The ultimate oscillator, after giving us an extreme positive reading, has been declining now for the last couple of weeks. So that's slightly negative. The vortex, which is now negative on the daily chart. The red line is crossed above the green line. We're still looking okay here after getting a very, very high reading and earlier in 2024. The Copic curve is showing that this momentum oscillator is still negative, and we're also negative on the daily chart. We're coming down here to this 10-week moving average, and that pretty much equates to either a 40 or 50 day, depending on how you measure this. Usually I use a 13-week moving average, but this is a longer term support level. A lot of folks are going to be seeing this and they're going to go, oh yeah, baby, buy the dip. Okay. And we could see a bounce up off of that. Or, oh my gosh, things are falling apart. They could sell and we could end up going below that. We're also keeping an eye on the long-term equity put call ratio based on 253 periods. That's the usual number of trading days each year. When this is declining, that tends to be more positive. When it's going up, that's negative. We're kind of flattening out right now as the market's going through a little bit of problems. We also look at the VIX, and then we take a 3-month average of the VIX and do a ratio between them. This is starting to go back up, which is slightly negative. And then our different charts. We were looking really solid with the Heiken Ashi here with open candles. We now are seeing a black candle. The Kegi chart is still positive because it's black, but now it's pointing down, where it would be more positive if it was pointing up. The Renko is still looking positive, and the 3-line break for right now is still looking positive as well. Then I have two different things on this chart. There's equi-volume, which is an attempt to visually combine price and volume together. When it's a green or a red candle, that's up or down. The thicker the candle, the more volume actually went into that particular move. Some folks might find this helpful. And of course, we've been down for the last couple of weeks. What I follow also is the ease of movement, and this tries to measure the path of least resistance. Is it to the upside or to the downside? Longer term, we've turned negative on the daily chart, but longer term, based on 14 weeks, we are still positive on the weekly chart. And we're still looking at a long, tall up with our point and figure chart. We don't see any new O's drawn in here yet. We are falling back, but this was giving us a warning for quite some time. It was actually generated, this was generated on March 4th. On the daily chart, it was generated March 7th. So it's been around a while, meaning that all these X's, meaning that maybe we're going up too far, too fast. And that could be why we're seeing the decline that we're seeing now. Then here's longer term momentum studies. This is a weekly chart. And then long term, we're starting to roll over with the PPO. The intermediate term, we're rolling over. We're actually turning more negative with the short term. And then I plot a 50-day cycle. I don't know if there's anything to this or not. We hit a new cycle on spring, even though it started a couple days early this year. And we have been coming down. Is that going to continue throughout the remainder of this cycle? When we look at the Elder's Impulse system, we continue to be neutral. We've been neutral for the last 3 weeks. And we're now negative. This is kind of major. We've switched over to negative on the parabolic SAR daily chart. We now have a dot on top. I tend to view this as a very important indicator. Now, we could get that back, but this turning negative is not a real positive sign. Then looking at seasonality, we are in the month of April, where it is one of the better performing months of the year. Looking at, and sometimes I just like to look at bar charts or even line charts, because the ultimate indicator is price. You can put whatever indicators on these charts that you want. It's price that determines whether you're seeing a profit or a loss, not what a particular oscillator or moving average is doing. We have to use those things to try to tell us what price is going to do. But just looking at price by itself, we're seeing a bit of a pullback with the S&P. The mid caps, the small caps never really did break out and are still really trailing behind. The Dow is still in an uptrend, but it did drop below its 13-week moving average. That's a bit negative. It's still at support when we look at the daily chart, so it could bounce up off of that. The NASDAQ holding up a little bit better here and has not dropped down below its 13-week moving average yet, so that's still intact. And the NASDAQ 100 also coming down to this 13-week moving average. And if you look at the daily charts, both for the NASDAQ and especially for the NASDAQ 100, we're right at support. We're right at some pretty significant levels. So we're seeing a convergence of things, both short, even intraday and long-term, that are all coming together right now. That's why I say if the market's really going to be able to bounce, things are coming together for that to happen. Where if that doesn't happen, that could really be negative. Here's a weekly chart. We've pretty much been going sideways with the QQQs. The mid caps came all the way down to the moving average, but they're still in an uptrend. Small caps fell below the moving average and have just been chopping more or less sideways. The NYSE came down to its moving average. See how these things are lining up? The Wilshire down to its moving average. All stocks not quite down to its moving average. This looks at stocks in the US and combines them with international stocks, but it's still in an uptrend. The biggest software companies fell below their moving average, but still above this longer-term 50-week moving average. FANG index holding up fairly well. It's the mega caps that are not doing great, but they're not falling apart, at least yet. They're still above the moving average here and in an uptrend. ARC never really did participate in the big upward move. It ended up being down on the week and is dropping below its 13-week moving average. The banks just got hammered on Friday, starting to fall back a little bit here with the RSI, but we're still above 50. The momentum had been positive, but now we're starting to roll over as measured by the MACD. The deposits still seeing money going into banks, just showing a little bit more of confidence there. And then this is just a plain chart of Dow theory, where we're setting recent all-time highs with the Dow, but that's not being confirmed by the transports, and the utilities have been under a lot of pressure lately. Broad market measures, the CRB index. And this is what we thought was happening, where a lower interest rate environment, where it's okay for the commodities to do better. They can go up in price without it necessarily concerning us from an inflationary standpoint. And so we are seeing some improvement, and some of this is coming from gold and silver right now. They're doing really well. But we're starting to switch back, it looks like. This is just speculation on my part, where we're going back to what we saw more in 2023, where instead of it being a type of an environment where other things can also do well without producing inflationary concerns, now we're switching back to, okay, inflation is a concern, and we want to keep an eye on growth versus value. We want to watch interest rates, and we want to keep an eye on the economic reports. But for right now, both on the daily chart and on the weekly chart, the CRB index is in an uptrend. Oil is also going up, but this is more for geopolitical reasons. If oil is going up because companies are making more money, that's fine, and oil can go up during those times. But because there's uncertainty happening, that's geopolitical, and the market is taking that more as negative. Copper continues to go up as we're seeing stronger than expected economic reports, and the dollar is really going up as well. And we're starting to see a golden cross here on the weekly chart. We've already seen a golden cross on the daily chart. Gold is just shooting to the moon, even though it closed well off of its highs. And of course, the people that talk about gold, they're like, I was telling you this all along. Yeah, you were telling us that back in 2010. All right, silver also seeing a bit of a breakout, but really closed well off of its highs on the week. Looking at the price of bonds, they are still in an uptrend, but seeing some weakness coming down here to the 50-week moving average. But longer term on a monthly chart, stocks are still outperforming bonds. And we're coming down a little bit with our 1 month, and we subtract the 3 month yield, where it should be negative all the time because 3 months is further out than 1 month. But it's been positive now for quite some time, and we're not sure if that should be a cause for concern or not. This is a daily chart of yields where we have been going up, but we did decline in Friday's session. Here's a weekly chart looking internationally with the US, UK rates leading the top, followed by German rates and then Japanese rates. This is a chart that I've been showing since last October when we spiked up to 5% with the 10-year yield, and then we've been coming down. No, now we might be going back up. Sometimes when that happens, bad things happen after that. But there's been other times on this chart where we spiked and it wasn't necessarily something really bad that happened. We don't know at this point, and we've been waiting since October to see if something is going to happen, which of course could happen at any time, but it's been more market conditions that were bringing interest rates down. Now they're starting to go back up. So we'll see if there's an update to this chart at some point. This pretty much says that same thing. Real rates pop bubbles. Real rates just means that they're taking inflation into account, where we had a very high reading and are starting to come back down. Now it's going back up. And there's other times when we saw these kinds of readings and it ended up being something negative. Some relative studies, intermarket analysis. We still have oil in the lead, followed by gold, stocks, and then the dollar, where bonds based on price are negative on the year. Then we look at a ratio between the NASDAQ 100 and the S&P 500, and we're still doing okay. Both have been under some pressure lately, but the NASDAQ 100 held up a little better this past week, and the NASDAQ 100 is still outperforming. The S&P 100 is continuing to outperform the S&P 500. Again, they both didn't have very good weeks, but the bigger stocks are holding up better than the rest of the S&P 500. Growth of value, this is an area where we're seeing some improvement. And if we are going back to the type of environment that we were in 2023, we want to watch these growth to value ratios. And this is going up, and that could be positive for stocks. Gold is breaking out when compared to the S&P 500, but it's still in a longer term downtrend. And it's also breaking out compared to the dollar, where it actually broke above this trend line and is really showing some improvement here. Then we look at kind of an inverse where bonds are underperforming stocks. This is a weekly chart here. And low volatility. Now, when you take low volatility stocks, which did really better in 2022, they're doing okay by themselves. But when you look at a ratio between them, they're doing terrible. They're really underperforming the S&P 500. Discretionary to staples, a lot of this has to do with Tesla. It's such a big part of the discretionary sector. It's still doing okay. It's been chopping sideways lately, and it's still in an uptrend, but it's just not showing a lot of strength right now. And we compare that to staples. Discretionary, the things that make life fun. Staples are the things that you have to have. Energy, making a comeback, even though it's still on a longer-term downtrend when compared to tech. Then some long-term cyclical, that's shorter term, and secular, that's very long-term. Cycle studies that we do, we're still looking okay here. We're working off of the October 2022 low, and this is still hanging in there for right now. We also have a ZWAG NYSE breadth thrust. The last one was triggered back in late October, early November. We're still working off of that one. We had another one triggered about a year ago, but that has pretty much fallen off the books now because it's over a year old. The Zohorchak, with nice solid Midwestern name there. This is still on a full-on buy signal, and these signals don't come very often, and it's been on a buy signal for quite some time now. So that's still positive longer term. This is a long-term chart going back to the 1987 crash. We're still well above this trend line. This looks going back just to 2018 to show that we're still well above this trend line as well. So we still have major support, still quite a bit under current price. This looks, and I started showing this again in the daily video because at least the indicator itself that I use to base this indicator is starting to turn more negative, but this is a 50-period moving average of the new highs minus the new lows for the NYSE. So this is a broad market measure. It's above zero. That's positive, but it has been pulling back. And the raw indicator itself is actually turning negative. Then we have the 50-period exponential moving average of the new highs and new lows just for the S&P 500. It is also falling back, but it's still above zero. Then we look at the NASDAQ 100 weekly chart. We're still above this trend line, going back to 2009. And then this is the ratio, and we're actually, it's kind of funny. The perma bears, they're just sure. They were looking at this chart saying, everything's over, it's done. You might as well close the stock market for good. We came up, we hit this high level back in 2000. It took us many years to get back up. This was the end of 2021. We came down. We started to come back up. This is when all the perma bears are like licking their chops saying, okay, I'm shorting everything I can find. This ratio is still going up. Even though the market is under pressure right now, the NASDAQ 100 is holding up better than the Dow, because the NASDAQ is growth, where the Dow is considered to be more value or the best of the best. We're breaking above this previous ratio right now. And the reason I chuckle is I'm not a perma bull, I'm not a perma bear. I like to think of myself as a perma realist. Markets go up and markets go down. Here's another similar look where we were seeing some weakness in this chart a week ago. This is the QQQs, the NASDAQ 100 with the small caps. We're coming right back up to this really high reading that we were getting way back in 2000. Then we look at the cumulative new highs, new lows for the NASDAQ. They're still continuing to go up after they had been declining for years. Down here is just the raw indicator that I look at. And then we want to keep an eye on this. This is the 3-month yield. It's flattening out for right now, so it's not really causing us any concern. If this really drops, and especially if it drops in relation to some kind of big event like the Great Financial Crisis, that's when we would get concerned. But for right now, we're doing okay. Seasonally, and these are some charts that I just show in the weekly video. This is put out by Dan Bird. He has a free weekly newsletter that you might find useful. I have his email address in the description below the video. We're not really sure where we're at right now according to seasonality. We're seeing a little bit of choppiness possibly coming up in here to the middle part of April before we see some strength going into the end of the month. This is what we have been following for the most part. We're comparing 1982 forward with 2023 going forward, and we've actually exceeded what had happened during that time. There are folks that like to take what's happening now and compare it to what's already happened. I find that interesting and I find it useful, but I don't use that to make decisions myself because things never quite copy themselves completely. Then I've switched this from the daily video over to the weekly video, just looking at the month of April, going back to 1950. We're up 11 out of 18 times, down 7 out of 18 times. The return is 1.3%. During an election year, no, I guess the previous one was an election year. Okay. We're up 71.6% of the time with an average return of 1.5%. And then however you measure it, whether you go back to 1950, the past 20 years, past 10 years, or during an election year, April tends to be positive. April is also one of the more positive months when you look at all the months together. And then on a global basis, April ends up being the most positive month of the year. This is a newer chart that I found from Carson at Isabel Net blog charts. Late April has been much better since 2000. We sometimes see some difficulties at the first part of April, or a lot of times it ends up being better later on in the month. Then the last thing here is Tom Bowley. He comes out with a weekly or a monthly newsletter, and he puts that in the newsletter. It's free. He posts videos for stockcharts.com. He also has another site called Earnings Beats that may interest you, where April is a bullish month, where industrials tend to be weak. Energy is hot, which, yeah, it is right now. But he still has us in this positive time period based on his research before we end up going into some weak times and then seeing some positive action going into the end of the month. Thank you. Thank you for putting up with my stumbles and fumbles there. I hope you have a really good weekend. I will be preparing the intermarket analysis video, the deep dive video, and the what to watch video. I'm going to go rest for a while now, and then I'll try to put those videos together later. So have a great weekend, and I will talk to you in the next video.